and we'll have an hour together, and this is our opportunity to talk to one another and for you to ask questions and me hopefully to come up with coherent answers to your questions. So we will have an hour together, and usual story, if you're one of our supporters on YouTube, we'll push you to the front of the queue. If you do a super chat, again, we'll push you to the front of the queue. And always it's good to start with a little bit about what we've been doing and some of our content, recent content that I think I'd like to highlight, I guess. And maybe a good place to start is with a podcast, which this week was about China, because that's very relevant and it's certainly been moving markets, the size of the stimulus, which we saw in China. So for example, let me see if I can do that. Yes, I can. Here we go. So many happy returns. Beijing's big gamble. Stock markets saw on China's stimulus. And make no mistake, it was a big stimulus. And the question is whether it's big enough. But it's certainly affected markets in China. So stocks have been rallying very hard in China, up about 25%, something like that, maybe 30%. And also my copper portfolio, which I created recently because I thought China was in the doldrums and that was pushing down the copper price and I thought it would turn around. Well, you know what they say, it's better to be lucky than smart, and it actually panned out pretty well. So copper as well has increased quite significantly after a dip, it has to be said. So certainly in the commodity markets, that's been reflected in the Chinese equity markets, but also things which are related to China, things like the Aussie dollar, for example, things like companies which sell their products to China. All of those stand to benefit from this stimulus, because it just got to the point where the economic data was so bad that I think the authorities just had to do something, and something big. So that was, I think, why they eventually capitulated and decided to create the stimulus. So do listen to the podcast. I think you'll find it interesting, entertaining. Michael always does a great job of structuring it, guiding the conversation and adding to it. So I think you'll enjoy that. Again, let me reiterate that we've now got that on YouTube, and I'll give you the URL as always. So if you haven't subscribed to that, let me just give you the URL, youtube.com/ here we go. Yeah, it's youtube.com/ Many Happy Returns Podcast, all one word. youtube.com/ Many Happy Returns Podcast with an @ before it. And yeah, you can listen to it on YouTube, and eventually I suspect we're going to do video for that too, but not yet. But you can listen on YouTube or Apple Podcasts or wherever you get your podcasts, Spotify, for example. It's a little bit less formal than my usual videos because it's difficult to be jokey during those videos. I don't think people want the jokes. I think they want the content. But with Michael and I, it's quite casual and jokey. Some people like that. So, yeah, that was our podcast. Markets, obviously, China's dominated the news. But generally in risk assets, it's been pretty positive. The S&P's been pushing new highs. Volatility's been falling, fairly low. Of course, people are thinking about what's happening geopolitically, but markets are quite cynical in the sense that if it doesn't affect US earnings, profits, then it doesn't affect equity markets usually. So things can be pretty bad elsewhere, and yet the US doesn't necessarily sell off. Oil prices, if those surge, so let's say that there's some strike by Israel on Iran's oil producing facilities, and then Iran decides to create a choke point in the Gulf for shipping oil, then that could push up energy prices, and we could suddenly see a replay of the energy price spike that we saw recently. Maybe not as extreme, but certainly significant. And if that were the case, then we'll have another inflationary spike. Rates would have to stay higher for longer because there are second round effects of that energy price increase. So, you know, I'm just worried that we're going to go down that road again, and it was all quite tedious, and it'll probably happen again. And of course, the geopolitical instability is never pleasant. Deaths are not pleasant. War is not pleasant. And if it does escalate and broaden that war, then, you know, it would be an atrocity on both sides, I think, potentially. So let's just hope we don't go down that road. Let's hope that sanity prevails. So I think that's the kind of backdrop. Market's okay. Complacency, I'd say, in markets. US valuation's still very high. And I also did a recent video about equal weighted indices, which you may find interesting, because a lot of people are saying, I want to tilt away from the Magnificent Seven. One way to do that would be to buy an equal weighted index. But it actually turns out that that has a very big tilt to small caps. So anyway, watch the video. I think you'll enjoy that too. And what else? I think that's about it for the kind of summary bit. So if you do have any questions, please do a super chat, because obviously then we kind of gives us a small payment. We'd appreciate it if you could do that. So I see we have some questions already. Let me just open the Laura document, because she kind of keeps an eye on the questions. I had some headshots done today because I went to have my photos taken, and so I had to take all of my outfits, my huge wardrobe, my tiaras, my lipstick, you know, the usual stuff I wear for YouTube, to look my best. And the lady was very good. She did a great job of trying to stop me looking scared, which I usually do for photos, which is odd. Yeah, so we've got a question from Dan Veneri, who's been a member for 2 years. Thank you, Dan. And so he's been a member for 2 years. Hello, Ramin. I hope you're doing well. Which money market funds do you suggest? I know this is not a recommendation. That's the great things. That's the great thing about having regular viewers. These people, they know that we don't provide advice, we don't provide forecasts, we just provide education. Now let's have a look, because we use a chat forum called Mattermost now, and it's got all the history going back to 2017 for all of our chats. So now I can see if I've made comments about money market funds, and I think I did recently where I kind of showed the latest. Here we go. Yeah, good. Which I will share momentarily. Here we are. There we are. So this is what it looks like on Mattermost. But the question was, what's the current rate of return on money market funds? Now, money market funds in the UK, they track the SONIA rate, that's their benchmark, the Sterling Overnight Index Average. And what I've done here is I've taken the price of accumulation money market funds. These are the ones that gradually increase over time. The income is reinvested. And what I've done is I've taken the price to 22 days apart, because that's one trading month, 22 trading days in a month. And then I've annualized that increase such that it's what you'd get over a year if you extrapolated that 22 days out to an entire year. And that's the blue line that you can see here. The yellow line is the Sterling Overnight Index Average rate, and that's the benchmark rate which many money market funds use. And what's interesting is if you look at the yields currently, almost all of them are above the SONIA rate. In fact, I think all of them are. The one I use, CSH2, this ETF from Lixor, the people who never agree to speak to me, who always ghost me, they seem to have got quite volatile. So can you see the spikes there in the price of CSH2, which is kind of interesting. Now we don't know why that's happening. Maybe there are outflows, maybe there's a liquidity issue, but because it's not transparent, because it's done with a swap, it's hard to know. But you can it's still generating the SONIA rate. Notice also that the SONIA rate's fallen slightly by 25 basis points because the Bank of England cut its bank rate. And it tracks bank rate, is a little bit lower than bank rate. So bank rate is 5, SONIA is 4.95. Notice also that there's a bit of a lag because the average duration of the instruments in a money market fund are about a month. So it takes a while for new issues to come along with a lower rate, and gradually this will fall back down to the SONIA rate. But notice how also they all have very similar returns. It's quite noisy data because it's annualized 22-day returns, but broadly they all generate the same return. So it doesn't really matter which one you choose. If you're on a platform that only has ETFs, then CSH2 is pretty much your only choice of an accumulation money market fund. There isn't a wide choice of them in the UK, despite their popularity now. The rest are all funds, which means that if, for example, you're on Hargreaves Lansdown, where funds are very expensive to hold, you choose CSH2 because it's an ETF and the holding fee is much lower. So, sometimes on some platforms there's a restriction. Vanguard's money market fund as well is now available in income or accumulation forms. And that one is very transparent. You can literally see everything in it. But these are the yields you're getting currently, about the 4.95, a little bit more. So the reason why people ask me this is because they say, well, when should I switch out of money market funds, which fall in terms of their return as the bank rate falls? When should I switch out into GILTS? So again, we can have a look at the GILTS, and so this is our Mattermost thread all about this, where we've kind of discussed it. Back to me. So let me just quickly fire up our trackers, just so you can see the gilt yield curve. 12, I have to do some sums to log in. One moment. 9 plus 3, yeah, I can do that. Here we are, and I'll share again. So we'll go down to our macroeconomic trackers, and we'll take a look at the UK yield curve, which my colleague Patrick Haddo updated today based on yesterday's closing prices. Here we go, UK yield curve. So these are all 64 UK gilts, which are currently outstanding, going from maturity of 0 years up to 50 years. And this is the yield on the y-axis for those gilts. Now you'll remember that 4.95, which is around just off the top of this graph, is where the money market rates are. And even the highest yielding gilt is only 4.6. So it's still not the case that there's a huge term premium. You're not really rewarded for locking in a rate for a long period of time in the UK gilt market. So I don't think it's time yet to switch to gilts, unless you think there's a shock cut coming from the Bank of England just around the corner, which I doubt. The UK services inflation is still very high, very sticky. It certainly has the MPC worried, the Monetary Policy Committee, if it does remain high. So I think it's unlikely to be cut. I don't think bank rate's going to be cut aggressively by the Bank of England. So there we are. Not really worth, I don't think, switching out of money market funds at this point. So let me switch back to me and your questions. So I hope that answered your question, Dan. But I don't suggest one. They're all much of a muchness. They're very similar. You saw the returns are very similar. And for members of our community, we have a list of the cheapest funds. And those 6 that you saw are very cheap, right? They're all very low fee. So I think there's not much to choose between them. But as I say, there are platform constraints. On an ETF-only platform, you have to choose an ETF money market fund. And on Vanguard, you have to choose theirs because they only offer their own funds at the moment. Supper Chat has done a super chat. Thank you, Supper Chat. John Ford. Hi, Ramin. Is it all right to have GILTS ETF? Oh, it was Laura that wrote Supper Chat. There we go. Is it all right to have a GILTS ETF and money market fund along with my VWRP in my Vanguard SIP? Yeah, I mean, the kind of money market fund and the GILTS ETF, if I had to kind of create a rank order of Laura fixes spelling. She's gone back to super chat. Sorry, Laura. So just imagine how lucky you are. You don't have to work with me. So if I had to rank danger or risk, the money market fund would be the least risky and the lowest volatility choice. Then we've got the GILTS ETF, which has duration, so it locks in a rate for some period of time. If it's a standard GILTS ETF where it doesn't specify the maturities, then the duration will be 7 to 10 years, roughly belly of the curve kind of duration, which means it will be volatile. Its volatility will be what? Probably less than 10%, 7, 8, 9%, something like that. But certainly volatile. As yield curves flop up and down, the price will flop up and down as well with this 7 times multiplier. And so that's the kind of intermediate risk. And then for your equity holding, that's the kind of high risk, high return, Scooby-Doo part of your portfolio. Whereas the gilts and the money market funds are the kind of Velma, staid, slightly boring, slightly specky part of your portfolio. So that's the way I'd kind of characterize it, what you've got in the Vanguard SIP. But that's absolutely fine. You know, you've got your risky component, which generates long-term return. You've got your safe component, presumably to dampen the volatility and let you sleep better at night, perhaps as dry powder, so that if markets do tank, you can buy more equity. Of course, if markets tank and you're 100% equity, then you can't buy any more. But if you've got dry powder, you can. And there are always kind of setbacks for equity markets, so there's always an opportunity to buy at a lower price eventually. So it's useful to have that. But it is going to be a drag on return usually, because money market funds usually return about 5-6% less than equity, and a little bit more than inflation historically. But is it all right to have a GILTS ETF and money market fund along with your VWRP? Absolutely. Just remember that the gilts and the money market fall into the same kind of bucket of safety. Let me just pull out while we're on here, let's just trot out the base rates, because that's always useful if people aren't familiar with it. Credit freeze 2023, here we go. Yeah. So let's have a quick look at that. Yeah, so this is, let me make it a bit bigger. Can I make it bigger? Yes, I can. Here we go. So these are the long-term returns for equity, bonds, and bills. Now, bills, remember, are short-term government bonds, the same as a money market fund. So where you see bills, think money market. So this is for the US from 1900 to 2022. This is for the UK from 1900 to 2022. And these have dividends and coupons reinvested. So their total return, and you can see it as a nominal return before inflation is subtracted. So for equity in the US, on average, they return 9.5% per year. Subtract inflation and you get 6.4% real total return. So very good return above inflation for a century and a bit. And then if you go to bonds, you can see the return falls by about 4%. And then we get to money market funds or bills, and there you get 0.4% real. So a little bit higher than inflation, and that's critical. People often think that cash has a negative real return because we've just been in a period of ultra low returns, which were negative in real terms. That's very unusual. Normally you don't see that. So yeah. 4.4% real. So if you do have cash or bills, usually it's a bit of a drag on return. You can see it's about 6% less than the equity market in the US. In the UK, again, about 5% less, a little bit less than 5% less than equity. So pretty similar story. Inflation on average has been quite similar, US and UK, 3.4 in the US, 3.6 in the UK, a little bit higher. But those base rates are really useful because they calibrate what to expect for returns long term. So if you're putting money aside for 10 years, 20 years, and you think, oh, I wonder roughly what I'll have in 20 years' time, you won't go too far wrong by using those rates. So I think that's why they're useful. I think that's why they're useful. Yeah, so John Ford, I think you'll find that is absolutely fine. It's just a question of how much of those assets you want to have. You can dial up and down the risk accordingly. Amir Ketobchi, always nice to see you. And he's done a super chat. Thank you very much. And he's saying, here's hoping for peace in Iran. Keep up the good work, Ramin. Thank you, Amir. And I agree with your sentiment. Let's hope that sanity prevails and things get back on an even keel as soon as possible. Dan Veneri says, which provider would you go for? I guess you're talking about the money market funds. I'm completely ambivalent about the provider. Usually it's the platform that determines which money market fund I go for. So if I'm on Interactive Investor, for example, I could choose a fund, I could choose an ETF. It doesn't really matter because you have a choice of both. And that platform doesn't vary its holding fee according to whether it's an ETF or a money market fund. So there I wouldn't care which one I had. On Trading 212, it's an ETF only platform. So is Invest Engine. So there you have to have an ETF. On Vanguard's platform, you have to have their money market fund. So, I think it's the platform which would determine which one I'd use. And then I'd just go for the cheapest one on that platform because there's very little to distinguish between them. It's not like it's actively managed. It's not like there's a huge skill in managing them. They all buy the same things and there's not much to distinguish them. So I hope that answers your question, Dan, about which money market fund provider to use. I don't think it really matters. Next question is from M. Ahmed. And he says, he's done a super chat, thank you. He says, I'm considering uranium for my fund portfolio. What's the difference between URNM.L, so I assume that's a UK listed fund, and URNP.L. So let's pull those up and compare. Now what I'm going to do is use SharePad for this. So just give me 1 second and I'll add these. So I'll just show you what I'm doing. Otherwise you just hear me chatting. So I'm going to use my temporary portfolio. Temporary. Here we go. And I'm going to add those two. And that one's traded on the London Stock Exchange. It's the Sprott Uranium Miners UCITS ETF. And I'm going to add that to temporary. And the other one you said was URNP. So we'll add that as well. There we go. Sprott Uranium Miners UCITS ETF again. And we'll add that to temporary. And then I think you can do a side-by-side comparison. URNM and URNP. Here we go. So let's compare the returns first of all, which are almost identical. So immediately there's not a big difference. Since 2022, the returns are very similar, but not identical. If we look at the prices here, you can see that the top one is in pence, so that's traded in sterling. The bottom one's in dollars, so that's the difference between the two. One is dollar denominated, the other one is sterling denominated. So URNP presumably is in pounds, URNM is in dollars. That's the difference between the two, and that's probably the only difference between the two. If we compare ongoing charge, it's 0.85 for both, and fund net assets exactly the same, £201 million. And the UK one, I think they're both accumulation funds. Yeah, there we go. And if we look at the portfolio, obviously it'll be identical. So Cameco is the biggest holding, 17.9%, and that's the same for URNM. So same fund, different currencies. That's it. That's the only difference. So if I had to choose, I'd choose the sterling one, because then if you put money into it, then you don't have to convert your money to dollars, which will usually incur an FX fee, and you'll pay more to do an FX conversion, a currency conversion, than an institutional investor. So it's better to get them to do it and just trade the sterling version. So I'd go for URNP personally, as I'm based in the UK, and I trade in sterling most of the time. Although if you are on a platform like Trading 212, the conversion fee is 0.15%, and which is pretty reasonable. And you've got the ability to keep your currency in that currency even after you sell, such that you could just use your dollar account to trade dollar traded assets. This is not for an ISA, of course. You can't have dollars in that. So I hope that's helpful. And the next question is from Video Pack for 5 Swiss francs. Thank you very much for the super chat. I appreciate it. And the question is, what's your take on US dollar leveraged loans, sub-investment grade CLO returns given the outlook of US interest rate cuts? That's an interesting question. So if you're not familiar with it, let's just have a quick look at Federal Reserve Financial Stability Report. Because this is one thing that spooks the Fed. And again, if you want to find this for yourselves, which I always recommend, the Fed's a great resource of information. You can get the latest one of these. You can see they're published once a year. And what we'll look for is CLO, collateralized. Can I find it? No, I can't. That's because it's not the whole report. That's not good. Well, let's get the PDF and CLO. There we go. Collateralized. Here we go. Here we go. And yeah. So this is issuance of non-agency securities. So they're not guaranteed by the US government because they're very risky. What is a CLO? Well, it's when you take a loan, usually a low quality loan. It's issued by a company which has low credit quality, and then you combine those low quality loans into a kind of waterfall structure where you've got tranches, and you've got the lowest rated tranches is called the equity tranche, and if defaults happen, they eat away at the equity tranche first, and then you get kind of senior tranches above that and a kind of super senior at the top, maybe, with credit ratings getting higher as you go from the equity tranche, which is probably not rated, up to the highest tranche with the highest rating. And of course the credit spread is greatest on the equity tranche because that's the one that gets wiped out first. So it is a way of taking loans and combining them into a structured product where you can choose your risk and reward according to which tranche you go for. What's interesting is if you look at the issuance of these products, surprise, surprise, it went crazy up to 2006. And then what happened? Oh yeah, the financial crisis. And essentially the market died at that point. And it has had some resurgence. In 2021, there was fair old issuance. But in 2024, you can see it hasn't really gone anywhere near to where it was, even in 2002. So yeah, I think it's pretty clear that the delinquency rates are worrying people. So they're worrying the Fed. They increased notably, the Fed points out. So definitely there's been a deterioration of the credit quality. Let's just check when this thing was published. April 2024. So it's a while ago now. But that would be a worry, right? If things are cooling off in terms of the economy in America, I'd expect the default rates to increase on those CLOs. Also, if there's a problem in the real estate market or whatever sector those loans have been issued in, then I'd be worried about that too. And of course, the property market is the one that's really suffered. So once the Fed starts to cut rates, obviously some of the pressure will be taken off, but it's going to take a while for rates to normalize. And that can be a long time coming for some of these companies which are distressed at the moment. So I'd certainly be careful about getting exposure to that right now, particularly if things are getting worse for the US economy, if it is slowing down. It has to be said, there isn't a huge slowdown in the US economy. If you look at things like GDP, if you look at the PMI indices, so let's have a look at the US PMI index. This is published by S&P now. So manufacturing PMI is not the one. I want the services. Services PMI. Here we go. I share again. And this is free to read actually, or at least it used to be. Let's see if we've got the US here. S&P Global. Services PMI, here we go. So this was published on the 3rd of October, so that was today. And you can see the PMI index is above 50. So that signals expansion rather than contraction. So very little sign from this forward-looking indicator that the US economy is really showing signs of weakness. It's always worth reading the commentary here too, because Chris Williamson's great. He produces great commentary. Strong end to the third quarter, with output continuing to grow at one of the fastest rates seen over the past 2.5 years. GDP rose at 3% in the second quarter, and a strong performance looks likely in the 3 months to September. So very little in terms of red flags there. The upturn is also becoming increasingly uneven, with growth wholly dependent on the service sector as manufacturing has slipped deeper into a decline. So you can see a kind of divergence there, but of course the service sector is much more important in the US. Politics plays a part. It remains to be seen how the presidential election will affect growth and the extent to which lower interest rates might help revive struggling sectors such as industrial goods and services. And there are upside and downside risks to growth. But overall, you can see that even for a forward-looking indicator like that, it doesn't look like there's a problem. And that's positive for all risk assets, including CLOs. So maybe this is a buying opportunity if you're feeling brave. I'm not sure I am, but perhaps you're braver than me. Video pack. So I hope that answers your question. I think it's not an obvious answer, and I'd always push you to do your own research. In fact, we're currently preparing a video on how to use research in your own investing. I should have said like and subscribe. I didn't say that at the beginning. So I'm just channeling my inner Laura. I should be saying that. Please do like and subscribe. Even if you're watching in replay, we'd appreciate that. Next super chat is from ENP, who says, thank you for the super chat. They say, thoughts about tactical versus strategic asset allocation. This is straight in my wheelhouse. More in fixed income, for example, when equity PE ratios are higher, matching duration to interest rates. Oh, interesting. Okay. I think, look, there are momentum models, so, and they do work, right? So they're not perfect, but I think if you do follow some kind of momentum, cross-asset momentum strategy. And it's interesting, one of our members in PensionCraft, a really helpful member who we've actually rewarded by reimbursing his fees on the platform for a year because he was so helpful with other people. It's kind of like our employee of the month. It's like our pension crafter of the month. So, but he's got a momentum portfolio, and I think he's got a fair old proportion of his investments in those. And what he does is he looks at momentum for multiple asset classes, and I think he breaks it down by region as well for equity, maybe by sector too. And wherever he sees prices rising, that's where his greatest allocation is. And it has a look back period over which he calculates the momentum, which is optimized using back tests. That's his strategy, which is really interesting. And it performs well. For example, when markets do fall, he often dodges the bullet because he's kind of careful with the with the because of this momentum strategy. So that's one approach if you're going to have tactical asset allocation. Stepping back, the difference between tactical and strategic asset allocation. Strategic is your long-term weights. So you might say I'm 60% equity, 40% bonds over the long term. Just as an example, I've pulled out of the air. But then if there's a particular movement in markets, let's say there's a huge sell-off, well, in that case, you put more into equity because it's cheap. So that's the idea. You adjust your weights away from your long-term averages according to what's going on in markets, or based on valuation or interest rates or whatever. But is there a kind of foolproof way of doing that? I'd say momentum's probably the best one. And if you are going to do it, it does take a huge amount of discipline in order to work out when to switch, in order to determine when to buy and sell, and to work out how much you put into different assets. So it's a lot of work. The execution is absolutely critical, because if you change the goalposts halfway through your investment career, which you inevitably will, then you'll get strategy creep, and you'll just end up with a mishmash of stuff which may not perform well. So if you are going to do it in a disciplined way and be really strict with yourself about how you implement it. If you use 3-month momentum, stick with 3-month momentum. If that worked in the back tests, whatever it is you've chosen, just be brutally rigid about it and stick to your guns. Because if the back tests work, it probably will work. That's usually true. But, like all of these funds that get back tested, the minute the fund gets launched, it tanks. It's almost guaranteed. So, base it on back tests, but don't necessarily believe them. Use a simple strategy, whatever it is. Fixed income, I think, is interesting, because if interest rates are very low, then you haven't got much of a safety buffer. So there you'd probably choose to shorten duration, because what will eventually happen is rates will increase and you'll lose money if you've got long duration. If rates are high, relatively high as they are now, then you could keep duration a bit longer in the expectation that rates are going to fall. But it's not obvious, because a lot of this stuff is already priced in. So I'm not convinced that having tactical asset allocation is going to work. Personally, I don't. I just stick to my guns. I have the same one fund in my core, and that's it. That's all I do, because I think simplicity is more important than any kind of tactical asset allocation. If there was a huge fall in markets, and I'm talking about going from 21 times forward earnings to about 12 or 13 or even lower, well, yeah, obviously then I'd buy more equity. And I do have dry powder in my fund portfolio. I think it's about 10-12% of my investments are in dry powder, held in my fund portfolio. It depends whether you consider bonds a fund. I do. So my fund portfolio is probably more than 12%. It's about 20%. But I've got about 10% in dry powder, which I would use if equity markets tanked, no question. So I've said I wouldn't do tactical asset allocation, but actually I would. But it would be in my fund portfolio, wouldn't be my core. That's the distinction. For my core, stays invested, and I stick with those weights, and I keep it simple. One fund. But don't copy me. Don't do what I do. I think that's another important point. Do whatever you feel happy with, and it's got to be a portfolio, a strategy which you're willing to live with long term, and yours will be different to mine. Just back it up with back tests is all I'd say. The next question, super chat from he says, what happened to the elephant? Oh no, the elephant's gone. Oh my god, where's he gone? Oh yeah, I remember now. We shot a video for one of our clients, and so I said to Laura, "Do you think it looks unprofessional having the elephant in the background?" And Laura said, "Yes." Did she say yes? I think she did say yes. Teddy's just appeared. What should we give you, my friend? So we'll pause at that point, and I'll retrieve the elephant. But Teddy also thought it was one of his toys, because he does have a lot of fluffy toys. So he immediately thought it was him. Oh, good boy. Been a while since he's had a haircut, so he's irresistibly fluffy at the moment. A woman actually stopped the car in the street, and she said, "Oh, I love your dog," which I thought was so sweet. Only in England would that happen to someone. Do you want another one, Ted? One more before you claim your biltong from Laura. Here we are. He's a good boy. Oh, he's been very good. He's a good lad. There we are. Thank you, Teddy. All good? All good, my friend? You go back down to Laura then. Yeah? Yeah, he's off. There he goes. Let me just retrieve the elephant. Let me just go and get it for a sec. There we go. Pride of place. I think it's when Laura went to Whipsnade Zoo. Where was it? She went somewhere. And then I said, "Could you bring back an elephant?" And she did. There we are. Oh, and Laura replied already. Oh no, it was Rocky Cottage. "It got moved today. I was heartbroken. Apparently not professional." Or was that Laura replying? It was me that said it was not professional, and Laura that was upset, right? But there is the elephant, restored in all its glory. There we are. Brilliant. So how long have we got? We've got 15 minutes for a quick fire round, because people say I answer these too slowly. That was one of the chats once. They said, "Hurry up. You took 10 minutes to answer that question." And a super chat for Teddy. Oh, that is so sweet. Thank you, Jens. Super chat just for Teddy. I appreciate that. And Teddy will too. I'll just say, these are not cheap. He's worth it, though. He's worth it. That's a physics question. Oh, I like a bit of that. Light Katango says, as a scientist, is it worth investing in quantum computing technology, or is it but a bit like fusion, something that never really transpires in the real world? Great question. Yeah, I think quantum computing, if it really works, will be phenomenal, because it isn't just a matter of tweaking existing technology. And there's a great documentary by Hannah Fry, which was done under the kind of Bloomberg documentaries channel on YouTube, which Laura and I were watching a few nights ago, all about quantum computing. And it talks about qubits and how these quantum computers work. And one of her points was that this is not an incremental change. It's not like you've taken a microchip and made the transistors a bit smaller, gone to 1 nanometer instead of 5 to speed things up so the electrons take less time to slosh about and it's faster. No, this is completely different. So instead of solving a problem using a brute force approach, you actually consider all possible solutions simultaneously, which is something that a quantum computer can do, because if you've got, say in quantum mechanics, let's say that you've got a ball and you throw it in the air, in this case it would be an electron, and you throw it in the air, well, it won't be in the air because it's in a vacuum, you throw it to this point. Now in classical mechanics, if it was a physical ball, it would just follow a predictable path based on Newtonian mechanics. In quantum mechanics, it actually follows all possible paths, but the probability is weighted by the action, which is a specifically defined integral in quantum mechanics. So more wiggly path basically is less likely. The most likely path is the classical mechanical one, which Newton's laws would tell you it should follow, but it actually follows all possible paths. Apply that to computing, and instead of just solving a problem using all possible, by going sequentially through every possible possibility, it does everything simultaneously. So it's massively faster because it does everything in parallel. So if you want to solve a cryptographic problem, for example, a lot of the ciphers that we use currently are based on how long it takes to factor a prime number. And very large primes take a long time to calculate, to factorize. With a quantum computer, you could do it like that. So a lot of the encryption that's out there today would be cracked. So apparently, some people are storing currently encrypted messages in the hope that in future a quantum computer could very quickly crack the encryption, which is fascinating, right? But would I invest in it right now? No, because I just wait until there's a kind of working prototype, just like AI. With AI, until we got large language models, it was a very theoretical science. We had neural networks. I worked with neural networks when I was at Oxford as a postdoc. We modeled language acquisition for kids, but it was a really simple neural network with just a few hidden units. Now they have huge neural networks with millions of hidden units and all sorts of clever rules to work out how to not overfit data. And of course, they have these large language model structures with a recurrent structure inside it to pick up these long-term dependencies. So until those LLMs came along, it wasn't investable, I didn't think. Now that they do exist, yeah, it is investable, and you can actually start to see tangible benefits. Similarly, for quantum computers, I think it's still too early. You could also say that for space exploration. I think that's really promising. Things like mining asteroids, that could be immensely profitable. Things like SpaceX could be immensely profitable if it manages to really make a go of the satellite network, and really lots of people start using it, and it generates a lot of revenue. But that could be transformative. So I think a lot of these things you have to kind of wait, suppress your inner nerd. Tricky in my example, for me, for example, because I get really carried away with the narrative and I want to invest in it. So the way I do it is via companies like Scottish Mortgage, which do buy things like SpaceX when they're still private, and that scratches my nerdy itch, and that's what I do. But I think it's still too early for quantum computing. Ty says he's a quant. Ty says, I'm a quantum scientist. Let's talk. There we go. And Alex M says, reimbursing membership fees for helping others. That's brilliant. Yeah. I think it's just good because when someone asks a question now on Mattermost, which is our chat forum, so many people chip in with such good questions and such good answers. They beat me to it and they answer better than I do. And I think that's the kind of community you really want, one where people do help each other and we all help each other kind of learn. Because I still learn. I speak to the members, they come up with new stuff, they ask me questions, and I have to research those questions, and I keep on learning. And that's the kind of environment you want to be in. Not one that's dogmatic, where they're trying to force some philosophy on you. And this is my real problem with crypto, which is that people... It's almost like a religion where people force this belief that, they trot out the same old phrases, and I just think that's not helpful. I think, make it evidence-based, make it helpful, make it realistic. Don't kind of be a blowhard person who's always trying to make your point or make points or argue with other people. Try and be helpful. So that's the kind of philosophy we have, and the community is very much oriented that way. So yeah, do think about joining us if you haven't already. It's very cheap. We've also kept the fees low so that anyone can join. So hopefully it's not beyond the reach of anyone. What what else do we have? How long have we got? We've got 10 minutes. Plenty of time. Lots of questions. Don't forget, like and subscribe. And another, a little chatty dog with picture of Teddy. Thank you. Yes, that is very cute. Let's go back to your questions. Okay. Hi, Ramin. Here we go. So this is Tim Wood 101. SSAC and S&P feel like they've been moving in opposite directions recently. Can you superimpose and explain? Ooh, I wonder if it's currency. So SSAC is the iShares MSCI All Country World Index ETF. So let's add that to temporary. And we'll also add, what was the other one you mentioned? SSAC and the S&P. So let's find the S&P. That's GSPC, I think it's a ticker. Yeah. Okay. And we'll add that to temporary. So we'll now go to the temporary folder and add me. Temporary. Here we go. And we've got SSAC and GSPC, and we'll compare. There we go. Sorry it took so long. So the red line is the S&P 500. The black line is MSCI All Country World Index. And clearly ACWI is a global index. The S&P is obviously the US only. And the US has outperformed other countries. But 70% of ACWI, 65% I think is currently, let's just get the exact number. MSCI ACWI PDF. Let's just get the percentage for the US just quickly from the fact sheet of the index eventually. Come on, MSCI. So the US makes up 64% of ACWI. There we are. Yeah, I don't want that. And where were we? We there? No, we're looking at SharePad. So 65%, wasn't it? Yeah, 64, 65. So you'd expect the two to kind of be in line with each other. But I think the key point here is if you look at sterling, sterling's been strengthening recently, and that's not good news if you're a UK investor in US price. It should be all right. Yeah. So sterling's been strengthening over the last couple of months versus the dollar. It's weakened over the last week or so. So if you go back to October the 30th, that's when it kind of peaked. And ever since then, it's been kind of weakening again. But overall, the trend has been upwards at the same time as the S&P has been trending upwards. So if you look at my core equity holding, which is VHVG, that is sterling denominated. So even though the US makes up a large proportion of this fund, 70% I think, because this is developed, the currency's been going the opposite way, and the two have almost exactly counterbalanced one another. So not great news. It is hitting an all-time high, almost, not far off. 83 pounds is the price of the fund, but yeah, sterling's been a problem for it. But Andrew Bailey actually helped me at last by being a bit dovish, and so that's weakened the pound a bit. So that's been good for my global equity exposure. So I thank you, Andrew Bailey, for that. I never thought I'd say those words. There we are. How are we doing for time? We've got 5 minutes. I can answer a couple more questions in that time. Gavin Lawrence says he's been spammed spectacularly by that Nokia Bell Labs Hannah Fryad. But she's so good. You know, I really like her stuff. Plus, you know, she's such a great mathematician as well, and she can explain it, which is a really unusual combo. Most mathematicians are not very good at explaining what they do. Often because it's so complex, it is difficult to explain it in simple terms, but she can. She's so good. We've got another question. One of my favourite YouTube handles, Scipio Africanus. Brilliant. That emperor, Roman emperor. A super chat, thank you. And Scipio says, "Hi Ramin, can I have your thoughts on the ETF UC99? I'm considering it for my fund portfolio." There we go. So let's have a look at UC99. Ooh. Interesting. Let's get its description. So this is a US, it's issued by UBS, it's managed by UBS. ETF factor USA quality. And the ongoing charge is 0.25%, which is pretty good. It's an income fund, so it pays out income, yields low, and it's a quality tilt. Now that's going to end up with a lot of tech in it, even more than the S&P, because quality really favours the Magnificent Seven. So if we get the top holdings, top sectors, semiconductors 26, software infrastructure 24, consumer electronics 18. So tech really gets heavily tilted towards. So Apple makes up 9%, Nvidia 8.5%, Microsoft 8%. So a really big tilt to the Magnificent Seven, but also companies like Eli Lilly, but that's fairly high up in the S&P as well. But companies like MasterCard, for example, Johnson & Johnson, things that you wouldn't usually think of as being so heavily weighted. So yeah, I think quality is an interesting tilt. The times when quality underperforms is when you get a flight to shite, or a junk rally as some people call it, when people just buy rubbish stocks because they're so excited about stocks and profitability doesn't matter, valuation doesn't matter. In that kind of euphoria, quality usually underperforms. But I think the euphoria is not quite as much as it was previously. So I think that's a good tilt. I like quality as a tilt. It's just so expensive at the moment that I just kind of keep away from quality right now. I'm waiting for a big pullback. And then in my fund portfolio, I think I will buy some quality. It's been on the cards for a while. I've wanted to, but because of the Magnificent Seven and the overvaluation, I think it kind of keeps me away. And if you look at the forecast PE for that fund, it's 27 times forward earnings, which is very high. Remember, the S&P is 21 times, and the small cap index about 17 times. So, yeah, it's just the expensiveness. That's the problem for me, and why I haven't bought it. So I hope that's helpful, Scipio. Loved your empire, by the way. It's cool. Alberto says, "What about my questions?" So let's find Alberto's questions as well. Alberto, I can't find it, Alberto. That's the trouble with doing YouTube live. Alberto. And Laura actually said, "I can't see any questions." So we can't. It was a super chat, you say, Alberto? Did I miss that one? Ask it again. I'll answer. I can't see the super chat. Sorry. It's been a kind of technical screw up. I'll give you a second to ask your question. No, I can't see it. See if we can scoot down a little bit. Yeah, ask it again, Alberto. And Scipio Africanus says, "Thanks as always." Okay, no question from Alberto. Well, I'm sorry. Sorry we can't see it. That's really annoying. I definitely can't see it on the things. I can't see it in the list. Anyway, look, let's draw a line under it there. Thank you all for joining us. Remember, I do one-to-ones, so you can talk to me. We can have a 1 hour coaching session, PensionCraft.com/coaching. You can find out more there. Or if you want to join our community, our helpful community, and join the conversation there and ask questions and from our very helpful people, and maybe answer other people's questions, you can do that. Go to PensionCraft.com/membership. And don't forget our podcast, which is absolutely free, where my genius co-host Michael makes sense out of a rambling old man, and we have entertaining conversations about investing. We're also quite excited because we've interviewed someone who's really fabulous. So that podcast episode, I think, will be coming out next week. And yeah, thank you all for joining us. And remember to like and subscribe. Always, I have to say that. And take care and good luck with your portfolios.